Hey, what's up everyone? Welcome into the channel. My name is Brent, Investing on the Go. Today we're going to be covering our Fidelity option recap for August 2nd through the 8th. This video will be fairly quick. We're going to be going through some of our past calls, our premium for this past week, some of the mistakes that we made being trigger happy last week, the excess explosion of the market, and our overall mistake that we made, but how we're trying to fix it going forward. So if you guys are brand new here into the channel, I would really appreciate if you go down below, smash that subscribe, smash that thumbs up, and we're going to go through here fairly quickly. If you guys have any questions, drop them in the comment section down below. So we're going to be jumping into the carryover. So from last week, I sold to open my call option on SPY at a strike price of $7.44, and I collected $509.32 in premium. The market had recovered going into Friday, so I was expecting this week potentially to break around 754, having some resistance in that time, in that range. So I was willing to sell with a strike price of 744 plus that 509 that we received in premium. Increasing our ceiling would be about 749.09, right? 744 plus 509 per share would put us right around $749.09. But instead, what did we see? Well, the early week, we had a Monday breakout continuing into Tuesday and Wednesday. So Monday, we opened up 749.39. We put on a 1% gain there just on Monday alone. Tuesday, we broke above the all-time high. Here's my lines right in through here. We broke the all-time high on Tuesday open. We continue to climb on Tuesday. And Wednesday, we did hit that new all-time high of 776.85. So that is where we were at on, the middle of the week, early week here. Now, what happened instead, right? I kind of already discussed this, but the S&P 500 was pushing 772 by Tuesday, and I was giving up that difference from 772 for my strike price of 744. That's $28 difference per share, times that by 100. I was giving up essentially $2,800 worth of upside in under just a few days. So I needed to roll my call option out. So here's the cost breakdown. So I initially made my $509.32. I had to close out that call option. It cost me $2,300. Well, if I subtract it, right? So it did cost me $2,893.66. So I was in the bucket by $2,384.34. Now, I did have to quite a bit extend my option out. So I wrote a call option for 12/31. I received $3,139.27 in from that premium. And the difference here, if we were to do that, is I'm making $754.93 in premium that I'm able to keep. But this means that going forward over the next 10 full weeks, so from August 11th, in the next 10 weeks beyond that, I was making an average of around $500 of premium per week. So I'm giving up a little bit of potential here. I'm giving up around $5,000 of potential premium in order to roll my call option forwards. But I'm able to capture more of the upside, and we'll kind of break down the math here in a minute as to the reasoning behind it. So why did I shoot for 780? So here's my new strike price. I wrote a call option for December 31st, a strike price of 780. So I went from 744 to 780. That is a $36 difference right there. So why did I shoot for a strike price of 780? We started this uptrend back in November 2022. It's been pretty consistent with some wiggle room. So we could potentially be breaking right around $820 by the end of 2026. We're going to go ahead and pop over here to the Chrome spreadsheet, and we'll do a little bit of a sheet, right? Take a breakdown through here. But we can see here the S&P 500 started its uptrend in November of 2022. We've been in a pretty good channel. The channel is pretty easy to see. We have those highs, we have these lows, but overall it's been pretty consistent. If we pop over here to the last few months, and we look at where we are going to be potentially hitting by the end of December. I can get this to, let's go to the 6 months instead of that. And we'll go ahead and bring in December, squish this down. And if we follow the trend right on through here, September, October, November, December, here's our December 1st, and then here's 2027. We potentially, the high point of this channel would be $820. And I did write my strike price for 780. So we have quite a bit of room to go to hit that December price. Let me go ahead and pop the PowerPoint back up. Boop. So 820 could be the high by 2026, but there's a lot of wiggle room between here and then. So here is the math between the old strike price and the new strike price, okay? So my 100 shares, not $100, but 100 shares would have been sold at $744. That would have made me $74,400 plus that initial premium of $509.32. Netted me $74,909.32 cash in my pocket right now. But with that cash, I would have less cash and couldn't write in the money or at the money puts. So right now, the S&P 500 is trading at 772. I wouldn't have the capital in my account to write at the money put options around 770 to collect that higher premium. So I would have to be selling deep in the money or out of the money, right? I would have to be selling puts around 750, in that time frame, around 754, 757, which at these prices, if I were to look at the upcoming October 17th, I believe is Friday, that would only net me around $75 this, being out of the money. It'd be a lot less premium. So what I chose to do instead here is I did unlock about $3,600 worth of value. Instead of having a strike price of $744, I rose my strike price up to $780. So here's my gain with the past premium and the new premium. That's $739.87 is my cost. So this is my cost basis right now. So on the S&P 500, my shares, my cost basis is $739.87. The new strike price is $780. That would put me at a $4,013 gain plus that premium from the rollover of $754.93. So instead of having the $74,909 right now, by the end of the year, I'll potentially end up with around $78,754.93 instead. And the net realized profit will be closer to $4,767.93 per share. If we take the $780 that I'm selling at, plus add that additional premium of $7.39 per share, that'll put me at a share price of selling of around $787.55 by December 31st. So I am giving up, 820 could be the high. It could be even higher than that. These are just projections, right? So we are giving up roughly $33 of potential upside, but this is below the 26 estimate of $820, but there's a lot of wiggle room that can take place. We have midterms coming up. There's a lot of things that could be taking place between now and then, and that could just be an opportunity for us to buy it back. So here's the lesson that I learned. Obviously, I was a bit trigger happy going into last Friday, and as I said before, I'm not rolling this specifically for the premium itself because the premium is only $700. That is not the main focus here. The main focus here is not the income, but it's the upside decision. And I did end up choosing to go with the upside toward a closer December ceiling. So between now and December, the market could fall, bringing my call option a lot cheaper to buy back and making it less expensive. In the past, it has dipped down below $16, whereas now it's at $30 to, sell that option or buy that option. If the market does pull back, that call option could get as cheap as $16, $15 or even less. So I have set triggers at $15.70 and $11. So if between here in August and December, the market has some bit of a pullback and making that call option a lot cheaper, it could be profitable to close it. And either way, whatever option does take place, whether the S&P 500 is to climb, we break $100 by the end of the year, and I have to sell these shares at 780, it will overall still be profitable because we bought these 100 shares at $739 and some change. So either way, it is a win-win, and there's a lot of wiggle room between then and now. So guys, that is going to be the update. So what is your guys' option strategy if you guys are selling any sort of calls or puts on SPY or anything else? Let me know down in the comments section below. And again, continue to subscribe if you guys are interested in the weekly income dividend portfolio updates. As far as the Fidelity option stuff goes, this will be kind of on a pause at the moment, just because of how long we do have between August and December. Obviously, if there's some volatility that allows that call option to become cheaper and I'm able to close it out for a good profit, then I will do so, and we'll make an updated video on that. New capital will still be flooding into this account, and I'll more than likely be buying either some potential meta shares in order to bring my meta shares up to 100, so that I can begin to sell some options on Meta. But we'll do some updates on the Fidelity side when something takes place over there. Otherwise, that is going to be it from me. If you guys have any comments or questions, definitely drop them into the comment section below. And again, if you haven't yet subscribed, I would greatly appreciate you guys going down below, smashing that subscribe, smashing that thumbs up, and dropping a comment down below. What do you guys think about this call option roll forward? Do you think the strike price of 780 is too low? Do you think 820 is very low on the S&P 500? Do you think we'll blow above $800, $820? What are your guys' estimates for 2026? Let me know down in the comment section below. Again, if you guys enjoyed the transparency, definitely subscribe, and I'll see you guys in the next one. Bye-bye.